Hi there. This video is primarily for our investment management clients. Each January, we do a review of the investment markets the previous year, as well as share some information looking forward into the new year. Which is what I'm going to do on this video, as well as a few other uh, ideas that I think are timely, my general thoughts. And as you're listening and thinking about this, I think that the best thing to do is to be thinking about in what ways, if at all, how does this relate to you? If you are viewing this and you're not an investment management client, then and you have some questions, you'd like a conversation, feel free to reach out. This probably won't make as much sense, but obviously in the video world, you never know who's this is being shared with and so forth. So I focus on comprehensive planning. When you do that, there's multiple areas: estate planning, tax planning, insurance planning, income planning, investment planning. And what I'm going to share with you is very heavily investment planning focused, and I heavily encourage everyone to not overlook any of the other areas. And obviously, if we work together, that should be familiar with you to you. If you have any questions about that, please let me know. We often educate, and we have other materials discussing these other areas, but today is investment focused. And our contact information and some general other thoughts as far as our common approach for those that may not be as familiar as others. Hopefully it's familiar to you. And in addition to being investment and insurance license, I also hold these educational designations: wealth management certified professional, retirement income certified professional, and life and annuity certified professional. What I'm going over today is just general information before implementing anything based on these suggestions. Talk with a qualified professional. If we work together, talk to me. If you don't work together and you're thinking about, you want some help, let's have a conversation about that. See if what ways we could help, what ways that might be a fit. But oftentimes the right choice for one person is not always the right choice for someone else. And I think that's definitely the case here. So definitely keep in mind, as what I'm sharing with you is not, I'm not recommending you do any specific thing based on this. So let's look back at 2021 with the investment market. So Brookstone has a slide like this generally each year, which I'll share with you the 2022 slide. But we like to look back and go, well, how close were we? How did the markets do from what people were thinking? And I think with everything that the world's going through, it's even more so than normally tough to predict the future, right? But bond rates, the 10-year bond ended the year right around 1.5, so actually right in the middle of this projected range. Stocks, I'll have a slide coming up. So the S&P, I think it was 4758. So the stock market, the general stock market, did much better than projected, anticipated. I will also review what some of the top analyst investment firms projected as well. So as of January 8th, 2021, interesting to see here that the highest prediction was 4,400. The median was 4,000, 6.49%, and you can see that the S&P 500 finished the year up an amazing 28.68%, well above any of the projected forecasts. But that doesn't tell the whole story. Most people are not going to be invested 100% in the S&P 500 or have their assets invested in things that perform similar to that. Obviously, that's an index. You can't invest directly in an index. So we're going to look at different equity indexes. And so obviously you can look at other years data, but I'm going to focus on the 1 year data. And really interesting, right? So the Russell 2000 small caps, the performance was almost only half as good as the S&P 500, right? And then here's the Dow. So I think a big thing to keep in mind is like, what indexes am I paying attention to and looking at, and understanding that a diversified portfolio probably the results on that were very different than some of the major market indexes, right? Multi-year thing we've been talking about is, does it make sense to be invested, or I've been talking about, does it make sense to be invested in bond funds? If the answer is yes, you need to have a really good reason for that. As in my opinion, there are some other options that would be expected to make a lot more sense. And so if you're not going to use those other options, then you should have a really good answer or reason as to why you're not and why this makes sense. So the really interesting thing in summary was that a lot of fixed income bond categories performed kind of as we would have expected. And so if you diversified portfolio, if you're wondering, you had this in your portfolio, they were, for the most part, negative for the year. So high yield bond is also referred to as junk bonds. So the default rate risk is generally considered a lot greater. And so the risk premium is like a lot higher. But because of all the stimulus money, the frequency of defaults were a lot less than most people, or most time periods may occur in different time periods. So that wasn't an issue last year, and so they performed a lot better. Commodities really had an amazing year. I know we hear about inflation, right? The cost of gasoline and goods and services and materials and wheat, barley, all those things, right? So that's a really interesting takeaway. Looking at the different subsectors of the S&P 500, there was also dramatic dispersion in the results, right? So you can, they're called sectors. So one of the things that I think is really interesting to look at this time, is in general portfolio rebalancing and really looking at some of the investment holdings that did really well and really asking questions, right? Does it make sense to maintain? Does it make sense to reduce? If you are going to reduce, where should that go, right? And those are the types of questions and answers that you and your advisor should come up with. I think that if we're, those are very personal as far as individual risk tolerances, timelines, and all that. And I'll share with you a couple general thoughts in a future slide. Quite often, you see that over periods of time, you don't generally see one specific sector or asset class just continue to perform dramatically different than other ones, but it can happen. And right, past performance is no guarantee of future results. So, but I think it's interesting to try to think about, right? Is there a reason to think that the things that didn't do as well might start doing better, or the reason to think about the things that did really well might not continue to? The S&P style indexes. So the S&P 500 is large cap growth, a lot of technology. There's a small group of companies that make up, a large percentage of that index. And so the interesting thing is that some of the smaller and mid-sized companies where value outperform growth. So that's kind of a big conversation, or a common conversation on media you'll hear. And TBD, right, to be determined, right, to what degree that may continue or not. But one of the things I'm not sharing on this recording, we may have some slides on that for our January 24th presentation in person in Sun City Aliante. And I can definitely share with, in one-on-one conversations, is some different ideas around this idea of some of the things that perform dramatically different than the general market. And does that, and in what ways might that be an opportunity for that individual? So my general or my current view on a portfolio allocation in the current environment for a moderate risk tolerance individual. We're in or approaching retirement. And if you've heard me talk before, this should be familiar. There's a new little slice in here. So right now these slices is 15, 25, 50, 20, and 40. So that makes up, the 100. And then obviously it's going to adjust based on an individual's risk tolerance. And so most of our investment clients are going to have at least 2 of these slices or sleeves, most maybe 3, and in some cases 4 or 5. And so here's a visual or a little more detail on those individual slices. So that alternative, that 5% slice, I think the question, right, a current consideration is, does it make sense to incorporate that within the investment portfolio? As a lot of holdings in this area dramatically underperformed the general stock market. And so the S&P 500, the NASDAQ, especially over the last quarter or so. So I share with you the primary focus of today was in reviewing the traditional stock-based investments, and many of those were up double digits, right? 15, 20, some even higher. And so a big question for individuals that have that holding, those types of holdings, is should they leave everything as is, or should they make some adjustments? And if they are going to make adjustments, what do they rotate to? So it's an interesting time I think, to potentially look at reducing that category and putting some into that category. For those that are definitely want to reduce, that would be increasing the expected risk, but going from equity holdings that perform well to those that underperform over a short time frame. So if you do that, I think you definitely need a multi-year outlook. That could definitely look and feel silly in the short term, you never know. And it could definitely do that in the long term as well. But that's something that's on my mind to discuss with individual clients. But definitely not going to make sense for everyone. Going down, if we continue down, we're going down in expected risk reward, right? And so that probably would make more sense for the majority of you listening. And most of our clients are very familiar with categories 2, 4, and 5, and much less areas 1 and 3. And so 3 is a new category as of let's say September last year. And we talked about that kind of these areas 3, 4, and 5 I consider in the defined risk category. They just have different features and functions. So if we are talking about your specific portfolio and any sort of adjustments, keep this in mind as far as a good starting place, and I can share with you my thoughts one-on-one. So let's focus on the 2022 outlook. The Fed is expected to raise short-term interest rates. That's what they've told the market, right? So the projected range similar to last year, but with the difference is the projected of a higher ending point than 2021 projected. The equities, the S&P 500, right? So we said 47.58 starting point. So considerable. Would not be surprised, right? If there's a decline, and generally stock indexes don't go up over and over, but they can't. That could happen. It could continue to go up before seeing a decline. Midpoint 5,005 and high point. This is obviously market results could be dramatically different than any of these, but this is Brookstone's investment committee's outlook. And let's take a look as well at some of the other Wall Street outlooks. So some of these investment banks. And you can see here, I believe there's only 2 on here that are projecting a decline, right? 4,600, 4,400. And the highest target, 5330 minimum. average. You know, in here 47.58. You know, if it ends up at the average, you know, that would be a 5.5% or so increase on the year. So things to keep in mind, and hopefully, if you have some questions, want to discuss your specific portfolio as it relates to these ideas, this would be help. This has been helpful, so you know what you want to focus on. Also, that if I'm bringing up the idea of shifting some of those category $2, you know, up or down, that this is not completely new to you, and we can talk about to what degree, if at all, that makes sense. So thank you very much, and I'll look forward to talking with you in the future. Take care.